please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Let's have some experts advise us. Geoffrey Dennis, Head Global Emerging Market Strategy and at UBS, and James Glassman, Senior Economist at JPMorgan, have joined us on the phone line. Good evening, gentlemen, and thank you very much for staying up for us. Jeff, first to you. Should we worry about this, the pause that the bulls have taken in the US markets and in, other equity markets as well? As well, should we worry about the rise in yields?
Well, I think you put the pullback in the markets down to two things. I think first the rise in yields for sure, and I think you don't worry about the rise in yields sitting around 2.7%. But if we were to see a further sharp increase in the short term, we would be concerned about that. I think the other thing that has clearly brought the markets down is been the new tariffs imposed by the U.S. government in a couple of sectors, solar panels and washing machines. That's raised the fears of heightened trade tensions around the world. So I think those two together over the last couple of days have really led to probably a long overdue pullback in markets. Today's action was pretty savage, there's no doubt about that. But the markets were overbought, and I think that they needed to have some sort of a pullback. And the big risk from here is a strong rise in yields, certainly, and also heightening trade tensions around the world. And we have to watch both of those things.
Hey, Jeff, morning. So if this is a long overdue sell-off or a pullback, as you called it, what should investors across the globe do? Because generally, a sell-off across global markets is a great buying opportunity, especially for investors in India. Would this time be the same?
We tend to think so, yes. I mean, we have the view the dollar's still going lower. We have a reasonably buoyant view of the global economy in 2018. We don't expect bond yields to go materially higher than they are now. And so one would think against that sort of a background that this sell-off will not go that much further. I'm not going to try to call it on a daily basis, but we would think this is a buying opportunity, including, of course, in my world, which is emerging markets, which have had a fantastic start to the year and had a big sell-off today. But they're still up 8% on the year, and I think this does represent a medium-term buying opportunity.
Okay. Geoffrey, good morning. Since we're discussing emerging market in India, I wanted your thoughts on how foreign investors would approach the budget tomorrow, and if there's introduction of long-term capital gains tax. Do you think there would be significant disappointment if that happens?
I think there'll be certainly significant disappointment if there is an introduction of a long-term capital gains tax. I think what we're focusing on is to see what sort of fiscal tack the government's going to take for the new year, the new fiscal year. The last full fiscal year, of course, before the elections in 2019. We are expecting the government to announce a slightly tighter budget. 3.2% of GDP is our budget deficit forecast for fiscal 19. But I think there'll be some focus on whether that's the number and also how we get there. Is there going to be a lot of money raised from the government selling shares in public companies, for example? So I think it'll be the details as well. And the bottom line here is the market doesn't really want to see significant fiscal easing into the election for sort of electoral purposes. Okay. And we suspect you're not going to see that. We think there will be a lower budget deficit target.
Okay, so fiscal deficit is what you all will watch. James Glassman, thank you very much for your patience. Would you worry about the rise in yields and the fall in the dollar, which actually looks a little contradictory in terms of moves? Do these have the makings of some financial instability at all?
I don't think so. I mean, I think we've all been wondering when are interest rates going to be moving back to something more normal. These are unnaturally low interest rates, and it's all happening because of the asset buying by central banks. So I think this is a healthy response to an improving global economy. And, when you think about what is the new news over the last several months, the new news that might be affecting the dollar is that the European region, finally, the lights are coming back on. And I think this is really more a story about economic trends building momentum in Europe and elsewhere, and not so much worries about trade protectionism. I mean, there's a lot of noise about trade, but honestly, I don't think markets fear that we are heading into an era of trade protectionism. This is really more about economic health.
I take your point about trade, but the only fear is, will there be more rate hikes than what the equity market is penciling in? To that extent, what will you expect from the FOMC as well?
Yeah, no, I think it's going to be all guided. It's going to be dictated by the performance of inflation, and inflation is very well behaved. The Federal Reserve is forecasting 3 hikes this year. I don't think they themselves are not the risk. If the economy turns out to be much stronger than they anticipated and inflation starts to move up, maybe there would be more hikes. But honestly, I think they will respond appropriately, I think, in proportion to what's going on. And I don't think that's the kind of thing that makes me worry about the global backdrop. It's really more if we should see an unexpected surge in inflation, that would be a problem for everybody.
Okay.
Sure.
But I think what we're seeing is a response to, finally, an improving global economy. And I think this is all healthy news, frankly. Bond yields are really a barometer of economic health.
Okay.
And so it's what you hope to see.
Okay. I wish we could say that about our bond yields as well. Thank you very much.